Hi, this is Harry Dent on June 19th, Tuesday, with an important update. There's a time for an investor or an investment advisor where you have to make a decision about getting out of an investment. And we think this is the time for stocks. We have the markets rallying this week on hopes of further Fed easing. And of course, as we say, the markets on crack always want more crack. So that's the number one priority for the markets. And then we just had this Greek vote over the weekend. It wasn't as bad as people assumed, and it looks like they'll be able to get some type of coalition. But this is not a done deal yet with Greece and Europe. Greece is going to be negotiating to reduce austerity, and the markets are likely to weaken as we kind of have this showdown in late June, early July or so, as the Greeks start to run out of cash. So again, with the markets rallying, this is an ideal point. We think later this week, the Federal Reserve is meeting today, Tuesday and Wednesday. Wednesday afternoon, they will announce probably some type of stimulus plan, a continuation of Operation Twist, or maybe some more quantitative easing. And the markets are likely to like that at first until the reality sets in over Greece and Spain and Europe over the coming weeks. So again, you can only tell this perfectly in hindsight, but we say probably Wednesday afternoon or Thursday, Friday at the latest, is the time, if you're still holding stocks, especially people holding high dividend stocks, thinking, the dividends they need for income in this time when it's hard to get yields and stuff. Our advice is get out of stocks altogether or greatly reduce your exposure because, again, we're seeing rising chances of this kind of great crash ahead we've been predicting now for a couple of years. It looks like we're about to hit that bang moment in Europe. So again, beyond the Greek elections and negotiations, what we're seeing is that the debt situation in Europe is rapidly getting worse. People know about LTRO. That was kind of their last form of quantitative easing, their QE2, $1.3 trillion in late December and February, and that caused us to think, oh my gosh, we're probably not going to have a major crash this year with this much stimulus and the Fed on hold for QE3. But look at how fast Europe has gotten back into a crisis and economic problems after that much stimulus. It shows that the stimulus is now starting to become impotent. It's not working that well, and we expect that as we go forward in the United States as well. You got to remember, everything in the last decade, and even before, created a bubble in the economy. All the super low interest rates and stimulus plans, every time we had a recession, the early 90s and early 2000s. Government pushing down long-term bond rates and borrowing costs even more. Government encouraging banks to lend money to households with lower incomes and less affordability for housing. And then all of the Fannie Mae, Freddie Mac, and FHA to augment home lending. And then Wall Street comes up with mortgage securities for the more risky loans. And then, of course, the ratings agencies turn a blind eye and all this speculation, first in tech stocks, then in real estate, emerging country stocks, gold and silver now, commodities. All of this is coming apart. It increasingly looks like to us that stocks peaked in late March in most markets, and we're in the first wave down of a broader crash that is likely to get very severe by 2013 and likely to bottom somewhere in 2014. And again, we're only making calculated guesses here, but it does look like we're getting to that point. And when it comes to Europe, the United States started the last crash with its subprime crisis. Well, it's Europe with its sovereign debt crisis in southern Europe that is starting this crash. And again, people know about the LTRO, $1.3 trillion. They know about the bailouts to Greece, Portugal, and Ireland, and more likely to come. And now, all of a sudden, $125 billion to Spain over a weekend. What people don't know about is there's a lot more lending and loans being extended to Europe by the ECB. ELA is Emergency Loan Assistance. That is for when people start pulling money out of the Greek and Spanish banks, which is a serious threat to Europe and to those countries. They provide money so those banks can meet those withdrawals and not, encourage further runs. $270 billion of that nobody knows about. It's called Other in the ECB balance sheet. More important, something called Target 2 loans. Central banks have balances with each other to settle trade among their countries. The stronger banks, especially Germany, are letting these payments from the weaker countries' central banks just lax and let them be put off because they're in trouble. It's another form of stimulus. 1.25 trillion in the equivalent of US dollars, over 800 billion from Germany alone. This means if the weaker countries exit the euro, not only does Germany lose, and countries like Germany lose the exports, which they have advantage of being in the euro, but they also get defaulted on this, and then the ECB gets defaulted on all this LTRO and all this ELA and the bailout funds. And then commercial banks lose money. Spain had the biggest real estate bubble in Europe. It lasted 3 years longer than the US, went 30% higher, got up to 13% of employment in construction alone, more than twice the US at the top of our bubble. Spain is unique. It's not only too big to bail out like Italy, it has a real estate bubble with falling demographics for buying real estate in the 30-plus segment for decades to come, down 40%. This is true of all Southern Europe, Central Europe, Germany, Austria, Switzerland. So again, there's no bailing out in this stuff. The demographics are against, the debt is growing. What's happened here, this should be the lesson. The stronger countries and the ECB keep bailing out the weaker countries thinking, well, if we can just turn them around, we can keep this together and they won't default and they won't devalue and we won't lose our exports and all these loans. But they're getting more in debt. And the truth is they're in denial, classic psychological denial about what's the most likely scenario, which is already proving more and more to be the case in Greece. These countries, after you bail out hundreds and hundreds of billions of dollars and add all this short-term and long-term debt, they default anyway. They exit the euro or devalue anyway and you lose your exports. This is a bad poker hand, and these strong governments should have folded a long time ago. So we see short-term debt, things the public doesn't see, this crisis building. I think there's likely to be a bigger crisis into the summer in Europe, and then a bigger one next year when countries like Spain are looking at exiting, not just Greece. And that could even, all of this could happen sooner. So with the risk, stocks we've shown around the world, 50 to 80% declines in all major markets we see. What's the upside if things really go well and we make a slight new high in stocks? 10 or 15%. That's the best scenario we can paint. So this is the time to get out of stocks. We think likely if the Fed comes up with some stimulus, stocks are likely to rally into Wednesday and possibly into Thursday, maybe even Friday. Somewhere after that Fed announcement, probably on Thursday, we're going to give a major and final sell signal in stocks. So be ready. And if you don't hear from us after this, look to sell. By the end of this week, we see targets as high, with some short-term patterns that we've been covering in our newsletter, as high as 1406 in the S&P 500 and almost near the highs, 13,200, 13,250 in the Dow. We get anywhere near there, this is a gift. Sell stocks. Get out, be safe, look to reinvest later when stocks are lower. And we're looking later this summer, if bond yields keep going down and slow down, that it's time to get out of bonds as well because yields may spike. So again, important time to make important investment decisions.